What's going on, team, and welcome back to another video. So today we'll be talking about fair value gaps. This pattern forms every single day and you can find them on any time frame, whether it's the 1 month or all the way down to the 15-second time frame. So what is a fair value gap? A fair value gap is a pattern that is made up of 3 candles. 1, 2, 3. And as you can see, for a bearish fair value gap, the low of the first candle does not meet the high of the third candle, which then creates this gap here. And for a bullish example, you can see the high of the first candle does not meet the low of the third candle, which creates the gap between the first and the third candle. Fair value gaps are formed because there's an imbalance between buying and selling pressure. So in a bearish example, there was too many sellers and not enough buyers, which caused this imbalance, or in other terms, inefficiency. And for a bullish example, there was too many buyers and not enough sellers, which again causes that imbalance. One thing to note about the market is that it's an organism and it wants to be balanced at all times. Think of our bodies, for example. Whenever there is damage inflicted on our bodies, our white blood cells go to patch up or cover up that damage. Think of fair value gaps as damage to the market. Because there's damage there, the market will want to come back up and cover these levels, or in other terms, fill the inefficiency. So why do we use fair value gaps? Well, we use fair value gaps for 2 things: our entries and our take profit levels. Here, I'll show you an example of how I used fair value gaps for my entry and my take profit levels. Before I show you this example, just keep in mind that we use fair value gaps in confluence with other analysis. For example, daily bias, liquidity sweeps, market structure shifts, and more. So just because you see a fair value gap doesn't mean that it's a good time to buy or sell. There's more to it than that. Alrighty, so in this example, you can see that we have 2 fair value gaps here. And if you can't see it, I'll show you now. So we have 1, 2, 3, and as you can see, the high of the first candle does not meet the low of the third candle, which again creates that fair value gap. And as you can see, we have 1, 2, 3, and the high of the first candle does not meet the low of the third candle, which again creates that second fair value gap. So now that you see the 2 fair value gaps, here's something for your notes. When you see 2 fair value gaps stacked on top of each other like this, what you need to do is enter on the first one, but respect the second one. So what that means is you would be entering on the first one, but putting your stop loss below the second one. The reason why we consider the second one is because it can tap into it, but doesn't have to. A lot of the times you'll see that it just taps the first one and takes off. So again, because we have other analysis techniques, for example, daily bias was in our favor, we got a liquidity sweep and a market structure shift. This is why I'm favoring the fair value gap for long here. It isn't just any fair value gap that I'm entering on. So if I let the trade play out, you can see that we tap into the fair value gap, then immediately seek for the fair value gap up here. This is just a simple example of how we use fair value gaps, but if you want to see more examples like this, check out the live trade recap section within the Discord community. And if you join the live streams every single Thursday, we cover exactly how we use these concepts. But with that being said, if you have any further questions on this video, please reach out to us through our questions channel located in the Discord server.